The India shining theme is back in media headlines and in investor conference tables. And this time there is some market backing for this theme. The Nifty has outperformed Wall Street indexes, for instance, this year by a comfortable 16 to 18%. The Indian Rupee has outperformed than three experts who have been listening to global investors and companies for the past few days at the JPM Investors Summit. Joining me from the sidelines of that summit are Puri, Chairman, South and Southeast Asia, JPMorgan, Jahangir Aziz, Head of Emerging Markets Economics and Commodities Research at JPMorgan, and Sajjid Chinoy, Chief India Economist at JPMorgan. Gentlemen, thank you very much for finding time for me in your busy schedule. Mr. Puri, let me actually address that question to you. Are you getting this strong pro-India feeling from investors and global companies at your summit?
Yes, no, I think there's very much a sense that this time we might finally be getting it right. I know there's always a sense that in the past, India has held out promise and under-delivered, and investors, of course, are naturally skeptical. But I am sensing a shift in the recognition that this could be our sweet spot. Part of this is just, of course, the stability of government and leadership and the commitment to economic reforms. Part of it is the shift in geopolitics and India's realignment with countries that could be now a source of both capital and technology. And we're beginning to see the benefits of that in EV. There are discussions around renewable energy, discussions around electronics, and the China Plus One strategy is obviously something which is ours to lose should we seize it. And alongside that, I think there's some recognition that we may have weathered the pandemic better than many other countries in the sense of having come out with a relatively strong fiscal and macro backdrop to this. So yes, I think there is a recognition that this is the time that India should be very much in the limelight. Okay. The last point actually which has come out, I think, is that from a talent point of view, Lata, India is going to provide 20% of global incrementally available talent. So if we can skill this, we could be a huge additive not just to India's growth, but to global growth.
Okay. But Mr. Puri, is this a change in mindset only, or a change that is on the anvil, or are global companies reaching out for their wallets or their checkbooks, as the case may be? Any evidence of...
No, I think this is happening. Yes, I think there's evidence of conversations around engaging with India. I think consistent with the Modi government, of course, many people are having to look at partnerships, joint ventures. So in the real economy and in terms of FDI, you are seeing a recognition that what we call the Atmanirbhar model is probably the favored model. However, people may have different views on that, but I have spoken to many global corporates who are acknowledging this and clearly understand this is the way to go. Okay. So yes, there's plenty of evidence that this is going to be a real event this time around.
Yeah, I mean, after all, Atmanirbhar is our version of friend-shoring, near-shoring, or investment in the home country itself. Jahangir, you look at a bunch of emerging markets. Is there any edge for India? How would you place Indian macros vis-a-vis other EMs and vis-a-vis other DMs as well? Because looks like we have inflation more than our target, but it's not as off target as it is in several DMs.
Sure. So, I mean, if you just look at the performance of emerging markets in the first half of this year, what is amazing is that, they were hit by three of the biggest shocks we've seen in a long, long time, right? So, we came into 2021 with already 2022 with already elevated commodity prices. Then the Ukraine war took commodity prices even higher. You had the massive pothole in China when Chinese growth in the first quarter completely crashed. And on top of that, you had the central banks, including the Fed, very tightening aggressively, and which led to a very strong dollar. Any one of these shocks could have taken down one or several emerging market countries. We've seen that in 2013. But if you look at emerging market countries, they showed a remarkable resilience. It wasn't that growth actually was much stronger than in 2021. But the fact that growth actually delivered, even at a subpar level, given the background of the shocks, suggests that there's a significant amount of resilience going through emerging markets. And the reason why that resilience was there was just like the developed markets, emerging markets true during the pandemic and in 2021, there was a significant amount of excess savings. Excess savings defined as savings minus investment by the private sector, and that was the basis of the resilience. Now, in the second half of the year, some of the resilience is going away because that excess savings is coming down. Some of the Latin American economies, some of the European economies now have to pay the price for the massive monetary tightening that took place 6 to 9 months back. And in the case of India, I think even though we are still talking about growth versus inflation trade-off, I think the part that is disturbing, and I agree with Leo about the medium term, but the part that is disturbing over the next 6 to 9 months is that in all of this talk about growth and pandemic, etc., we seem to have forgotten that twin deficits is back on the headline. I mean, if you look at center plus state, it's probably going to be around 11-12% of GDP. If you look at the current account deficit, it's running at 4%. We really should take a very close look at that, because the last time something like that happened was back in the first quarter of 2013. And at that point in time, how that story ended. So while the medium term looks bright, especially if India plays its cards right, as Leo pointed out on the China plus one policy, as you talked about in terms of French shoring, etc. In the very near term, I would say that, once again, twin deficits has become a problem that India first needs to get over before we can talk about what happens in 22-23.
But are we the outliers in that? The strengthening of the dollar is not creating current account deficit problems for others, or are we the worst?
There are only two countries right now among the top 15, 20 emerging market countries where the private sector saving investment in the end of 22 is going to be lower than in 2019. One is Turkey and the other is India. Even countries like Brazil, they're going to be around 4 percentage points of GDP higher. Indonesia about 6-7 percentage points of GDP higher. South Africa, same in that same category. China would be about 2 percentage points of GDP of higher private sector excess savings than it was in 2019. The two countries that are flashing amber, one of them is flashing red, which is Turkey, but one of them is flashing amber at this point in time is India.
Oh, well, that's very important to introduce a note of caution into this rah-rah story. Sajjid, the GDP numbers came in lower than street expectations, or even RBI expectations. 16.3 was where RBI stood at, and the Q1 GDP came in at 13.5. How would you estimate the growth story? Is there enough steam in the private final consumption expenditure to still bring in a 7% growth, or will it be a 6 handle? And what for next year if there are global recessionary clouds?
Lata, so the glass half full is what Jahangir mentioned, that you've seen the savings investment balance in India go into a deficit in a way that's reflecting the fact that the private sector is gradually recovering from the pandemic. And as we've previously discussed, I think it's incumbent then on the public sector to reduce its fiscal deficits. Of resilience, like Jahangir pointed out, but we need to be careful about what the drivers of those growth were. So last year, for example, we grew at 8.7%, and 3 percentage points of that came from exports, because you had a strong global rebound, right? That was almost 35% of growth. It will be unrealistic to expect in an environment where global growth is slowing, Europe is in recession, China is middling, for India to get those kind of export tailwinds. So we'll have to be realistic that the drivers of growth this time will be different. The fact is fiscal policy is consolidating, monetary policy is normalizing, the global economy is slowing. So even if we grow at 6.5% or 7%, that would be admirable in this much more difficult global environment. I think the key here is that the supply side problems on private investment seem to have alleviated, the twin balance sheet problem. Now it's a matter of utilization levels. And this is where I think, at least if sustained government capital expenditure continues for a couple of years, both center and state, there is a chance here that you can progressively crowd in private investment. But the fact is, given this very adverse global backdrop, we need to be realistic about how much we can grow for the next 12-18 months and double down on macroeconomic stability.
So the global growth story, that is the one that could create problems for India growth and not give us that export tailwind. I have to scratch that point further with the other experts as well. A quick break and we're going to concentrate on the global backdrop. Back in a minute. Welcome back. I'm speaking with three of the top minds from JPMorgan. I've been speaking with Leo Puri, Jahangir Aziz and Sajjid Chinoy. We spoke about the good India growth story, the India shining story, but global slowdown can cast some shadows, and that's where we ended the first segment. So Jahangir, straight away that to you. How bad can the global slowdown get, you think? I'm not worried about the more near-term 75 basis, 100 basis rate hikes. But can the terminal Fed funds rate go well over 4% and stay that way for a longish bit?
Look, I mean, that is most likely to happen, that, the terminal Fed, not just the terminal Fed funds rate, but other DM central banks like the ECB and the Bank of England, and maybe sometimes even in 2023, who knows, you could even have Bank of Japan joining that group, that interest rates will have to be lifted. And the reason why interest rates have to be lifted is because, the fears of recession, etc., that, we all went through in June and July, none of those have actually come true. In fact, the US is most likely to deliver about 1.2, 1.3% of positive annualized growth in the second half of the year, as opposed to minus 1.2. There is a recession that we are looking at in the case of Europe because of the energy price shock. But given the fiscal support that has taken place in England, in UK and in Europe so far, most likely that is going to be a bit shallower. China will get out of the zero COVID policy at some point in time, and the policy stimulus will hit through. The point I'm to make, Lata, is that while global growth is likely to slow in terms of what we were used to, let's say back in 2019 and before, I think it is not going to happen that quickly and that steeply. And as a result of that, most likely you will see labor markets remaining reasonably strong, and central banks therefore being forced to react much more aggressively than one would have expected, let's say in June and July, when these fears of recessions had more or less covered all our growth forecasts. Okay. We are in a very different place at this point in time.
Yeah, I read your report, and it does say that you all are not expecting things to be that bad, actually, and that's why you're even increasing the terminal Fed funds rate. But Jahangir, I don't think enough attention has been placed on quantitative tightening. The Fed's quantitative tightening increases from now on, and they could, after all, they've not withdrawn anything. If you compare to 2020 levels, their balance sheet doubled as of end 2021 from 4.5 trillion to nearly 9 trillion. And even if they go by the current pace of tightening, they would have barely taken off 6-7% of that. Will the tightening, is that tightening sufficiently analyzed, and can it
quantitative tightening on one hand, and making sure that the quantitative tightening that is ongoing is separated from the interest rate measures that they've taken. So if you look at the quantitative tightening, it is basically on autopilot. It is on an autopilot where it will take at least 2 years before we get down to something even close to what was the case prior to the pandemic. So it's a very slow absorption of liquidity. And all of that is done precisely for the arguments that you made. That missteps there, and we saw that in September of 2019, that even a small misstep there can create significant amount of repercussions in rates market and therefore to other asset prices. And I think the Fed is trying to be very careful with that. Now, will this experiment end without further accidents or accidents that might happen that are clearly, unintentional? Look, only time will tell. We never ever have gone through this process where we've done this amount of QE and then tried to take that amount out. But at this point in time, I think by keeping it on autopilot, by making it very, very slow, almost making it, as you pointed out, it's almost like watching the paint dry. Yes. That's the pace at which they're taking out liquidity. I think they are basically trying to make sure that you don't get these accidents. And right now, we can all hope for the best.
Yeah, but we have to keep that possibility on the radar. Sajjid, which straight away brings me to the rupee. Should we worry that there can be external attacks? If the Fed doesn't go beyond 4.5% or 4%, which seems to be the JPM base case, then perhaps we will tide over. But can there be, big attacks from the external front for India? After all, we do have a large current account deficit. What is your own estimate, and what should we expect in terms of possible external dangers?
So Lata, I would say, there is no need to panic because this is not 2013 in an important way. We've got significantly more buffers in place. FX reserves, if I judge it by import cover, still at 9 months today, it was 6 months then. If I look at gross financing requirements, it's 1.5 times now, it was 1 time then. So there's no reason for panic, and this is not 2013. The larger question is whether we should use the rupee as a shock absorber. And I've consistently had the view that faced with the current account deficit, which will be elevated this year, close to 4% of GDP because of a huge pickup in commodity prices, there are only 2 ways to bring the current account down. One is you slam the brakes on growth and choke off imports, which clearly we don't want to do in India, given the state of the recovery. The second is to use the rupee to achieve a narrowing of external imbalances and a weaker real effective exchange rate. That weakness can happen in a calibrated manner over time. Has been seen in the past over time to boost exports, bring down imports, and thereby narrow the current account. And actually, it's expansionary. Remember, a weaker rupee helps domestic growth. So in an environment where fiscal deficits are tightening and monetary policy is normalizing, you want a weaker currency to actually help you with growth along with capital expenditure. So I'll just end by saying this is different from 2030. The pressures are clearly there. If the dollar continues to strengthen, make no mistake, emerging markets will be under pressure. But it's different in the sense that we're not scrambling like we were in 2030 and there should be no panic. The question is how we use it as a policy instrument to narrow elevated external imbalance.
But RBI's big fear is that you allow a depreciation of some magnitude and it can become self-fulfilling and therefore generate instability. So I think they worry about that a goodish bit. But before I get to Leo, the more important question, and I will of course have occasion to discuss that with you in our Citizens MPC, but do you think that the Reserve Bank has a lot more heavy lifting to do, 50 basis next week?
We would expect a 50 basis point next week, Lata, just given what we've seen in the US CPI, where the Fed has to move. The fact is, as the RBI pointed out, inflation, at least for the next 6 to 7 months, is going to remain stubbornly above the 6% upper tolerance band. Monetary conditions are still very accommodative. Real rates are still negative. So I would agree with the RBI's approach in the last 3 months that the more you front load monetary policy, the lower the medium-term growth sacrifice and the lower you need to end up doing. So I would expect there to be another 50 basis point hike next week, to get real rates into positive territory in an ominously worrying world.
Sure. Now, to wind up, I want to get back to Mr. Puri. Mr. Puri, I knew you primarily as a banking expert in your earlier years in India. Now, the Indian financial sector has gone paces because of digitization and the arrival of fintechs, UPI, ONDC. Can all this considerably brighten the medium-term India story?
Well, actually, Lata, this is genuinely a bright spot. In fact, I find it astonishing that there is so little discussion today, and it's good news there's little discussion about the financial sector, because we have actually solved many of the dire problems that we had 4 or 5 years ago. Today, you have a sector where, in fact, credit is back to around 15% growth. Generally, Tier 1 ratios are healthy at all the major banks. We've carried out a process of banking consolidation, which is actually quite remarkable in terms of repositioning industry structure. And we've done this by actually having an industry context where ROEs are well above our Asian peers, let alone global peers. So today we have banks that are well positioned to support capital expenditure, investment-led growth. And it's just a matter of the demand and animal spirits coming back. But this has truly been a success story. We do have a healthy banking system today. And I think that's something which is a very strong foundation for the good news, if you like, if we can take it. The good news for India in a geopolitical context, which is what I highlighted at the outset. So this will be, we have to play the cards we're dealt with. I agree with my colleagues on the global caution. We can't be complacent. That's going to happen whether we like it or not. But in terms of what's within our control, I think we're about as ready as we ever have been to kind of attempt another, space launch for the Indian economy.
Oh, thank you, Mr. Puri, Jahangir and Sajjid. That's a great way to end the conversation. This is a superb medium-term and longer-term story, both because globally we are seen as well-placed and because internally there is a wave of digitization, especially in finance, which can distribute the goodies of growth to more people. But there is flashing amber in the near term on the twin deficits, so we have to watch our way. Thank you very much for joining me in this very special chat with the JPM Brains Trust.